Welcome back to Market on Close. It's time for the big picture. For that, we welcome in Collin Martin, Director and Fixed Income Strategist at Schwab Center for Financial Research, and Michelle Gibley, Director of International Research at Charles Schwab. Collin, Michelle, so good to have you here with us. Collin, let's start with you. Yields down today alongside the major averages here. What's going on? What should we be thinking about as we head into the weekend?
Well, right now, it's still all about the inflation outlook. If you look at the economic release calendar this week, it was relatively light with all eyes on the PPI and CPI reports. PPI came in a little bit higher than expected, but if we look at yesterday's CPI report, it was mostly in line with a modestly higher headline reading, but super core, something that the Fed's looking at pretty closely, did come in a bit higher than we saw last month. If we look at today, there wasn't much of a reaction. Import and export prices weren't likely to be market moving. If you look at the University of Michigan numbers, sometimes that can drive markets, especially given the drop in sentiment and the pickup in inflation expectations. But if we look at movement on an intraday basis, yields barely budged. I think CPI from yesterday was probably the key driver. As it stands now, going forward for the next few weeks, it really will come down to the inflation outlook and likely the labor market. We're still in the will they or won't they dilemma with the Fed, although the markets are basically expecting the Fed to hold from here on out. But it is pretty clear, and we got this from this morning's comments from Harker at the Philly Fed, that if inflation does reaccelerate, maybe there could be more hikes on the table. But for now, it doesn't look like we'll see them.
Collin, sticking with you for just a second, because this whole higher for longer narrative has really been what the market's been trying to digest for quite some time. And we were talking about this on Morning Trade Live this morning. Is it higher for longer or is it high for longer? Have we seen the peak in rate hikes? Is the Fed done, or do you think that there's still one more?
We do think the Fed's done, so that's a good distinction. Higher for longer almost implies there would be another rate hike. So if we just say high for longer, that kind of implies that we're sitting here for the next few months or however long it is. We do think the Fed will just hold here. Inflation is moving in the right direction. That's the main point we've been making as it relates to our outlook. We do think it's going to be a bumpy ride to get to that Fed's 2% target, but all signs indicate that it will get there. We're coming out of, obviously, this massive amount of stimulus. Numbers were a bit all over the place, but it does look like it's moving in the right direction over time.
All right. So, Michelle, the U.S. economy has been surprisingly resilient. Chinese economy, not so much, but you're starting to see some signs of stabilization there. Fill us in.
Yeah, next week we're going to get the monthly data for September as well as the 3Q GDP. And we're saying, pay more attention to the monthly data. The 3Q GDP may miss the full year 5% target. We think there could be some fiscal stimulus on tap. And additionally, when we look at September, what we've seen so far is some improvement. The official PMI figures rose. Credit issuance rose, and even inflation rose on a month-over-month basis. And even the property market has seen some benefit from cuts to down payment ratios and interest rates, but the recovery there is likely to be really drawn out and bumpy. And because the property market is so important for the overall economy, we're saying, investors might need to get used to slower growth for longer in China and just take a longer-term view. And, we always suggest being diversified when you invest in emerging markets.
And Michelle, I was taking a look at your notes, switching from China to Europe. You say sentiment on European stocks is so bad, it's good. Explain why.
Yeah, the U.S., as you mentioned, the economy in the U.S. has been better than expected. And it's resulted in some upside to inflation, but weaker growth in Europe has allowed inflation to continue to ease and really bolsters the case for the ECB to be done hiking. And, even though we've had this upside to data in the US and downside in Europe, the average European stock is measured by equal weight indexes is outperforming the average US stock. And that's because valuation is just so much lower. If we look at valuations in Europe, they're lower than historical average versus higher than historical average in the US.
All right, Collin, want to give you a chance for final word. What is the most important thing that fixed income investors should be thinking about right now?
I think for fixed income investors right now, it's to pay attention to the yields that are being offered. This has been our main theme for the past number of months. And even though yields have continued to rise, if you look at where yields are today versus where they've been for the past 15 or 20 years, we think yields are very attractive. Now, you can take a look at performance and how poor it's been, and that can scare a lot of investors away. Or you can be worried that yields might keep rising and it might prevent you from considering bonds right now. But we think for long-term investors, we think the rise in yields presents an opportunity. And if you look at the U.S. Aggregate Index, for example, it's a benchmark index of high-quality bonds. It offers a yield of around 5.5%. Now, it has an average maturity of 6 or 7 years, so that's a little bit longer than I think a lot of investors are used to. But for those looking for income and have been waiting for an opportunity to lock in these high yields, we think it's important to take a look at where yields are right now and consider investing for the long run rather than be worried about if yields are going to rise another 15, 20, or 30 basis points in the next few weeks.
All right. Keep that in mind. Collin Martin, Michelle Gibley, always a pleasure. Thanks so much.